Good evening, ladies and gentlemen, and welcome to another Melbourne Accelerator Program Masterclass. Tonight we're lucky enough to have two speakers. Aaron Wallace from Sydney, who's an Operations Director at Nudge Accounting, and he'll be going through the basics of accounting for startup founders. And secondly, we'll have Sean Moynihan. Sean is a Research and Development Tax Incentives and Government Grants Specialist. And he'll be showing you what kinds of activities are eligible for the R&D tax incentives and how to claim them. So I'd like to introduce Aaron.
Yeah, first of all, thanks for having me, and also thanks to Rowan and Alex for putting this on and focusing on a key topic such as accounting, which in startup land isn't something that startups initially think about. So whether we're looking at accounting or whether we're looking at R&D, it's such a critical component to at least have a basic understanding of what you're dealing with and where things are going. In terms of an overview, quick overview here, you would have seen this on the Eventbrite site, so I won't spend much time going through this. But in terms of startups, in terms of the type of startups that we deal with, we see, and Sean sees as well, a whole variety of startups across both tech and also innovation. So we're dealing with a whole range of startups at various stages of their life cycle. And so you can gain a broad understanding of what is critical to their success and to where they're going as a startup. So before we jump in, accounting for the founders. What are we looking at? Especially if you have a technical background, what are some of the key things that you need to understand? So this is accounting, an overview of accounting in 5 minutes. What's the first thing that you guys as founders, what are you focusing on?
Partnerships.
Partnerships.
Cash flow.
Cash flow. Profit. Sales. Revenue. What are we looking at? Well, when you go in and you're looking at creating something, ultimately the outcome of what you're creating is going to involve a level of wealth. You're building something, hopefully it will succeed, hopefully you're actually building something that will give you some form of return in the future. Investment. Yeah. So we're starting off with a focus, and that focus, and this is on the board as well, is wealth. If you've got a social enterprise, the outcomes might be slightly different, and it all depends on where you're heading. But in terms of startups, and in business in general, we're focusing on wealth, or in terms of an outcome that involves money. How are we going to get there? Well, in terms of the MAP program, probably the first thing you'll see is that if you're accepted into the program, you're going to get a $20,000 injection of funds into your startup. How else are you going to fund it? Family, friends, savings, bootstrapping, yep. You see all of those. Funding. Where are you going to get your funding from to actually get your startup off the ground? Yeah. What are you going to do with that funding? Launch party. Looks like Rowan's been to a few. Launch party. What next?
Decals for my MacBook.
Decals. We're looking at all the accessories, all the nice little things. What else? What are you guys going to invest in? People.
Assets.
Yep. Assets. IP. Yep. Brand. If you're a tech startup, what are you investing in? You're investing generally in people who are building a platform, and from that platform you're developing IP. Some of these things And I'll just fill this out a little bit. So we've got the funding here. We're using the funding to invest in assets. Yep, so put family, friends, MAP, etc. Assets, people. From an accounting perspective, you don't necessarily see people sitting on a balance sheet. You don't see them as assets. But in fact, for many startups, the people are the biggest assets within the business. People, the brand, the IP. There are a few guys going through MAP at the moment, such as Swatchmate, actually innovating, building something. Yeah, it is the IP, but it's also the product as well. They'll start to have inventory and all of those types of things that will start to come through an asset which they're now selling. Yeah. What can we see across the board there? We can see wealth, we can see funding, we can see assets. What are we looking at? A balance sheet. Yeah. Pretty simple, hey? What are we going to do with those assets? You can see this on the board as well, and this is something you can take away. We're using those assets to then make money. We're going to make that money now, we're going to make that money in the future. What are we doing? We're sweating our assets to actually generate a return. What are you selling? What will you be selling? What price will you be selling it at? So we're looking at sales. And then in relation to those specific sales, what costs do we have that relate to those sales? Direct costs. You're focusing on a tech startup. What are the costs? You might have someone clicking on a Google AdWord. Is that a direct cost associated with that sale? Do you have a sales team that are being paid commission based on how many people are coming through? If you're selling something physical, you have a cost of actually manufacturing that product. That's what we call a cost of goods sold or a direct cost. And then from there, we have what is called a gross profit. Sales minus cost of goods sold is called gross profit. Then following on from there, we have overheads. So the general bits and pieces of rent, salaries, you name it, expenses that don't relate to a specific sale. And then what follows up from there is our net profit. What do we do with that net profit? That's something we're aiming for eventually. What do we do with it? And we've got choices. We work our way down. We go sales less cost of goods sold or direct costs equals gross profit. Less overheads equals net profit. If we're making a return, what are we doing with it? We taking it out of the business, building up our wealth. We're paying off those who have funded our business. Or, as most startups do, we're reinvesting it into the business. Building up our asset base, building up our IP, protecting our brand, you name it. Up the top, we've got balance sheet. Down the side, we've got profit and loss. These are the two basic types of reports that you will see when you're running your startup. This is accounting 101. You're probably wondering why I've just got these two words on the board. I think sometimes the biggest risk after looking at a kind of a quick snapshot of numbers and the different factors, one of the biggest risks when running a startup is that you're so focused on the strategy and in terms of where you're going as a startup that that's kept in kind of one box here, and we're looking at the numbers are kept in a separate box over here. So it's one of those things that when looking at strategy, the strategy will feed into the numbers in terms of the output of that strategy. The numbers should then feed back into the strategy. It's just a cycle, it's an ongoing cycle in terms of how you're running your startup. At some point in the future, you will want to be making money from that. So the strategy should feed into the numbers should be feeding back into the strategy. It's an ongoing cycle. You can't look at them in isolation. They need to be very much in tow with each other. So you've seen the snapshot of what accounting is. I think the reason is why. Why are we actually looking at that? And time again, you can say, yep, I've got a business idea. I actually want to get something off the ground and I want to get funding to support that. And yes, you may get funding, and if you're going through the MAP program, and especially if they believe that what you're actually putting on the table is a viable idea, you will get the initial support and then you can continue to obtain support. But at some point in time, we're moving from an idea into commercialisation. And at what point do you actually put your hand up and say, I understand some of the key factors around finance, and I understand some of the key factors around knowing the numbers of your business and where it's going, which is then we're moving away from kind of this initial funding. And we're moving into kind of a bigger picture. And even at a seed funding round, you do need to have a grasp of what your numbers are and where you're going. And in terms of this overall process, what does MAP require? I'm not going to speak for Rowan.
It's on your slide. We don't require someone to have a corporation or an ABN because we can help them do that,
yep.
But they'll need to get that sort of figure.
Yep. And that's the thing, like it's, once you've got that idea and once you're getting off the ground, that's kind of one of the first steps that you need to go down the path of doing. Yep. We're starting off there. What are some things that you need to be aware of? That's not necessarily a numbers game, it's more a broader accounting game, but what structure are you going to have? Is it a tax effective structure? Is going to protect the assets of the founders? And also in terms of this discussion, and this is something that Sean will talk about later on in terms of the R&D, is where will your IP be held? So just some key things, some key pointers that you should be aware of, some questions that you should be asking around when you're getting your startup off the ground. Is this the right structure in terms of asset protection, in terms of tax? Make sure you ask that both for your startup but for you personally. And then when we're looking at cash flow, you've been accepted into MAP, the first 20 grand's come through the door. What are you going to do with 20 grand? Where are you going to invest it? What are you going to spend it on? How are you going to validate your idea? Do you have those answers? Hosting costs, expertise, beta testing. Well, we're looking at numbers already, aren't we? Because we're looking at how long will this cash actually last? So some key questions. Really critical questions. They're the type of questions that, in a nutshell, if someone is looking at your business and is looking at funding your business, these are the types of questions, in a nutshell, that they'll be looking for answers. What are you selling? Who is your customer? How much does it actually cost to acquire that customer? What revenues are you going to get from that customer over the lifetime of them being your customer? Then overheads. Five really simple questions in terms of what are you selling, who's your customer, how much does it cost them, how much will you make from them? Why is that so important? When you're selling the story of your startup, when you're selling the story and the idea, and then you're starting to look at the commercialisation pathway, what we're doing there, whether we're talking about customers, we're talking about revenues, we're talking about acquisition costs, we're effectively bringing it back to what we're seeing on the board here. We're talking about sales. We're talking about direct costs or cost of goods sold. We're talking about gross profits. We're talking about overheads. And we're making that connection time and time again between the operations of your business, the strategy, and the finances. I know this stuff looks pretty basic, but it's something that ties directly into the way that you will be running your startup. Let's talk about runways. Let's talk about budgeting. Let's talk about mapping out what the future will hold. Yeah. So what are the key operating metrics that you should be aware of? Obviously, product lines, how you're selling it. How are you going to sell your product? Are you going to put it on Kickstarter as kind of a precursor to getting funding in? Will you be selling it online? What are the type of metrics that you need to start thinking about? If you're selling something online and you're looking at kind of a runway, how many guys do you need clicking on your website to then have a conversion rate, which we know for online is very small, something like 3% conversion on a website, to then purchase something off your website with an average price or an average basket of goods, for you then to have money coming through the door. If you break it down, if you look at the operations and how the operations tie in with the finances, we're understanding a complete picture of how your business is being run. What idea do you have? How can you break it down so the operations themselves feed all the way through to the finances? You can't lose the disconnect between the two. We're talking about sales price, we're talking about direct costs. These all tie back in to this overall equation here. Because every dollar that we're making at this level here, at a gross profit level, is a dollar that will go directly to the bottom line. And you then have the opportunity of reinvesting that money back into the business or back into your growth plans, expansion plans, or product development. You can see that up there, every dollar at a gross profit level works its way down. In terms of mapping out a runway, what are we looking at? Think sustainable overheads as well. Can you kind of get free rent from MAP? That works for a while. What about staffing costs? As founders, you might not be paying yourselves for a while, but how long is that viable? At what point in time do you need to take staff on? And these staff won't be founders. So you need to start paying them market salaries. Can you afford that under your current model? If we're looking at sales, if we're looking at direct costs, and we're looking at the money that we've got there, are we making enough to pay them, or do we need to get more funding to help us actually keep this staffing team around? What will your overall cash position be? Will you need more funding? You're mapping out what the future will hold for your startup, but what will your cash position be, and when will you need to raise cash? So time and time again, when we're looking at it, you need to understand how your operations will run. You'll need to understand when the money will be coming in, and if the money isn't coming in, do you have the support there, whether through formal or informal structures, funding structures to support you as you're ramping up your business. And then obviously the last one here, which Sean will talk more about, is R&D and the R&D tax incentive and other grants. Is this going to be part of your runway? Should it be part of your runway? Or is it too risky an assumption at this stage to make it part of your runway? Just highlighting the importance of this connection again. When we're looking at the two together, I think the key word in the middle that ties the two together is how. How will the strategy play out in the numbers? How will the numbers impact your strategy and as a result your operations? And this here in terms of your investment decisions, in terms of some key things around cash, in terms of finding cash through alternate means such as Kickstarter and the like to fund product development, how will you use that to actually build out the pathway, the runway for your business? Look at all the options. There are more options pretty much month by month that are coming out in terms of getting funding from alternate sources as well. How can that actually help you extend the runway for your business and make the most of the opportunities that you have? While we're talking about accounting and Accounting 101, what are some tools that you can use? In a nutshell, you probably see some of the key ones, whether it be Xero, whether it be MYB, whether it be FreshBooks. Set up an accounting structure that will work for you with a budgeting tool that assists you in managing some of the key components of your business. When you are doing a runway, you want to be able to track how you're performing against that runway. So always look for a program that enables you to actually compare your performance to your runway and to your projected runway, generally through a budget. In terms of guidance, and there will always be people around the MAP community that will be supporting guys that are going through the program. But on top of that, you'll always find in terms of finance blogs, in terms of guys such as Shoestring or Startup Smart, there are generally guys that talk about specific issues that will impact startups. Pay attention to it, become aware of what actually is happening in terms of the finance space. What impact does it have on you? And as you're starting off in terms of tax issues and the like that you can deal with, go straight to the tax office. They've got a pretty handy website in terms of some key tips in that, especially if you're starting off, if you want to know kind of the tax implications associated with some of the decisions that you're making, do some background research, at least have a level of awareness of what some of the implications are. Just in terms of that, I'll hand it over to Sean now, who'll be going through the R&D and some of the tax incentives around that.
Yeah. Thanks for having me today. It's a real pleasure to talk here at MAP. Thanks to Rowan, Alex, and thanks to Aaron for, I guess, setting the scene and providing a good background to accounting and finance. What I want to talk to you about today, as Aaron has alluded to, is R&D tax incentives and why they are critical to startups and the capital that they can bring. But just before I get into it, I'd just like to maybe get an understanding from people who's heard of R&D tax, who thinks they know a little bit about it, who's never heard about it. So roughly hands up who's actually heard about R&D tax incentives. Right. Who thinks they understand it and can access it? And who's heard of other grants such as Commercialisation Australia? Okay, great. So it seems like everyone's got a bit of an understanding. The question I'm posing to you is, how can Australia's tax system help fund your startup? And when you think about that question, it is a little bit strange because everyone associates the tax system, the ATO, with revenue for the federal government, not as a source of funding for your company. So when you go to the ATO's website, Oz Industries website and so forth, they talk about R&D tax incentives, they talk about R&D tax offsets, and that really doesn't probably relate to too many people unless you do have a tax and accounting background and can manage to navigate your way through the 4 volumes of tax legislation, which are all about this thick individually, summing up to about this much of tax legislation. Combined with the fact that it's coming from the ATO, who is not perhaps seen as the most friendly government services. So in that sense, I can see how it could be a little bit scary and you might not actually understand what it is and what it means for you and your startup. So for startups, the R&D tax incentive is essentially cash refunds for startups, which then me leads to say it is startup capital. And not only that, it is quite a reasonable sum of capital. You do have to spend money first. It's not a grant where you get money before you spend anything, but it is a 45% reimbursement of eligible startup costs. And when I say eligible startup costs, that is anything around your development of your product and will be a high percentage of all your startup costs. So just to set the scene a little bit more about what we're actually talking about here and how much it is and what it means for startups in Australia. The first most critical important fact is that it's not competitive. You're not competing against other startups, which is the biggest difference between the R&D tax incentive and grant programs, and in particular, Commercialisation Australia. Commercialisation Australia, you are competing against everybody else. It's the best of the pool. If you happen to be in a really good pool, you may miss out. With R&D tax, it's an entitlement. If you meet the criteria, you are entitled to the money. There's no set limit or no pool that the ATO has to pay out. It just is whatever people apply for and are eligible for. In the financial year 2013, $1.8 billion was paid out through the R&D tax incentive, which is a huge number. Now, if we break that down again and think, well, is that just going to the big end of town? Well, of that 1.8 billion, 540 million went to small and medium enterprises, classified as companies with less than $20 million turnover. So that's significant as well. And based on our estimates of our client base, we believe that of that, 150 million goes to startups in Australia. Which again, as a fund, is a huge amount of money. and potentially even Australia's largest venture capital fund. So this is a whole different source of funding that's out there. It's a big pool. It's accessible. You're entitled to it. Then the next question is, how do you get there? And that's where we come in. We do help startups. And we've helped over 100 startups to navigate through the process, to help them get through the tax legislation, to understand what criteria do they need to meet, how do they need to meet it, what forms do they need to fill out, how do they go through the process. But before you go through that process, you need to have to make an assessment as to whether you're actually eligible. Are you entitled? Now, the first thing is you have to have a company. It's not for individuals. It's not for partnerships. It's not for trusts. You have to have a company. And going through the MAP program, they can help you incorporate, help you set that up, so that you do have a body corporate in Australia. And the next thing is you have to meet 3 key criteria for eligibility. You have to be developing a new or improved service, product, device, or process. Now, this is getting towards, are you developing IP? Are you developing something new? Now, if you're just replicating something that somebody else has done, you'll not be eligible for this program. But also, you may be not actually going about setting up your business and setting up your product and your service to market in the correct way. So you're most likely going to be developing some sort of new product or service, a device perhaps, a process. It needs to be technology or science-based. So there has to be some sort of development with technology. Most cases, for people going through MAP, if not all, it will be some platform that you're developing that has code, algorithms, so forth, data structures, which is new, which is going to actually enable your product or your service, which again is the new and improved service. And you have to go through an experimental process to get there, which is basically going from a concept through to testing in that iterative loop till you get to your end solution. And the last thing is you have to have $20,000 of eligible costs. So if you go into the MAP program, you get the $20,000 of funding, then you put that towards eligible R&D costs, you're in the game. You're now entitled, you're developing a new and improved service, you're doing it in an experimental way, you're using technology to get there. You've incorporated, so now you're entitled. And if we think back to the first slide, it's 45%. So on that $20,000, now you've just got an entitlement to $9,000. So now you're up to $29,000. Now, as Aaron's alluded to, you may be looking to other sources of funding, your own savings, family, crowdfunding, bringing that in, you're starting to build it up. You may be getting to 40 or 50,000. You're getting another $20,000 roughly from the government. So now you're building up towards more like 70, and we're talking about a little bit more cash. I won't go through all the details of the process, but the 2 key parties are the ATO, who pays out the cash, and a body called Innovation Australia, whose shopfront is called AusIndustry. So you make an application to AusIndustry. They have a form on their website. You fill out all the details, you lodge that, and we're always looking back. So you're making it the end of your financial year. You get through your financial year, you have your accounts. Now it's time to think about your R&D. Go out, get your application form, start filling it out. It's a lot of basic data, such as your company name, your ABN, your turnover, which in your case is most likely to be 0, your tax position, which is most likely going to be your costs, what your project is, what are you developing, what are your objectives, why is this going to be new and improved for the market, What is the process you're going through? What concepts are you developing? What hypotheses are you testing? How are you testing them? What are the conclusions been? Are you now pivoting and going down a different path? Why are you going down that path? And then the costs associated. And now you've already put in your good accounting practices. You have all your costs booked there. Now it's just a matter of assessing them. Were they related to my development? Or were they related to my startup launch party? In that case, we can't claim them. But was I out there researching? Was I talking to people? Was I developing? So it is going to be the majority of the costs of your business when you're in a startup phase. You pull these costs, you go to the AETO website, you get that form, you fill it out, you follow their guidelines. Again, as Aaron said, they have a lot of good information out there. You put that all through, you take it to your tax agent, you lodge it with your income tax return, and then within 28 days, you'll get the check from the ATO. That's basically the process. There's some more intricate things, thinking about how do I hold my IP, how do I maximize my returns, how do I structure that. Won't get into that today, but the things you should be thinking about. How do I keep getting this 45% refund year on year through my tax structures? Are they effective? So that's a good introduction into it. I hope I've answered the question, shown you that the tax system does fund startups. They do it in a very accessible and effective way. It's a good benefit. It's on a year-by-year basis. And it is a huge sum of money that's being pumped back into Australian companies year on year. So thank you.